Welcome back. Today we talk about return and risk. So let's start from what is the return. We are still in the part in which we want to understand all the key concepts so that we are able to build our strategy, a practical strategy upon this. So return just simply means that when we invest in something, we expect something bigger in return. And the return is the money earned as a reward for taking the risk of an investment. And so if we see this formula here, it simply says final value minus initial value divided by initial value. May seem complicated, but it simply means that if your initial value, the price at which you bought the investment, was £100, and now when you sell it, you are getting £120, what is the return? Well, it's 120 minus 100 divided 100. So it's 20 divided by 100 pounds. And so your return is 20%, right? And so the return, it's simply your way to say, okay, am I doing things properly? Because especially if you have a financial advisor, I may ask you, okay, how is your financial advisor doing? And if you tell me good, no, you should tell me, okay, he made this return or she made this return in this period of time. Otherwise, it's just talking, okay? So return is the most important metric that tells you how fast you are going with your investment journey. And the thing about return is that it grows over time. So in this example here, if we made 10% every year, it means that from the first year, we made a 10% annual return because it's the return in 12 months. It's now 110 pounds. Now 110 pounds, one more year goes by, 121, and so forth. The beautiful thing about return is that it will help us grow our money exponentially. And we're going to talk about this in a minute. But before doing that, I want you to understand, have some reference point of the return by asset that you can get. Now, when you hold your cash, when you have a lot of savings, your return is negative. Because the return that we are talking about is the real return. Real return means subtracting inflation. Again, we are going to discuss these topics in a dedicated section, but what you need to know for now is that when you hold your money in cash, whether it's pound, euro, dollars, you lose around 2% every year in a typical year, okay? If we take on a very long horizon, inflation changes every year, but on average, in a developed country, it's 2%, which is a negative effect on your money. On top of this, you have then the central bank interest rates, which change over time, but normally is between 0 to 3%, okay? This is in the normal average over the years. Then you get a lot of years in which you have higher rates, lower rates. We are going to talk about this. But the general idea, the way in which you want to refer to the central bank interest rate is that you never want to accept a return below the risk-free interest. And so if right now the interest rate of your central bank, which you can just type central bank of the UK or whatever country, interest rate right now, you find the number, you'll never want to accept an investment that offers you a lower return than that. Why? Because we have assets to just get the return that the central bank offers, which is considered the risk-free one. Risk-free because the central bank cannot go bankrupt. Like, if the central bank goes bankrupt, it means that all money is worthless. So it's a very, very catastrophic scenario, unless you live in Argentina. Then it's just another Tuesday. But jokes aside, it means that you don't want to never accept a return that is lower than this. So take that as reference. If you go further, we have higher returns, but interestingly enough, the average active investor return is not that high as you think. Because if you see on social media, it may seem that everybody's a great investor and they seems to do everything right. But the truth is that the average return of investors is between 2 and 3%. Because you need a lot of skills to invest correctly. So let's keep going a bit more. This is to give you a reference point. The point of this slide is to tell you this is what is realistic. Because social media gives you a lot of unrealistic expectations. You see people saying, oh yeah, you can get a 10% return per year, or sorry, per month or stuff like that. It's crazy. The truth is that if you do a very conservative strategy, like having a conservative balance between stocks and bonds, stocks being the ownership of some company in the stock market, bonds meaning some safer form of investments that we're going to talk about later. But in that case, you would have get a 5.8% return in the last 10 years with a 80-20% bond stock portfolio, which means 80% of your portfolio is invested in bonds and 20% only in the stock market. You would have been very defensive, very conservative. You would have got this return. Then we have the stock market average return, and you have the 10.8% as the average of the global stock market for the past 40 years. You can type it for yourself. I'm not making numbers up. Yes, it is possible that if you invested everything in the stock market for the past 40 years, you would have got an average of 10.8% return. And this is where I want to stay. I actually aim for myself to be on the 12% return per year because I take extra risk and so I want to get more money. But generally, I don't aim higher than this. Because I hear people say, yeah, it would be nice to do a 15-20% return or 25% return per year. Warren Buffett investment return is 20% per year. And so either you tell me that you believe that we can be as good as him, that does it full time, and we do it as a hobby on the side, and we make the same return. There's something wrong in that, right? So this is to base your expectations, especially for what you see online. Warren Buffett average return, I think, is 22%, okay? That's the highest threshold of being 24/7 in the stock market, being a genius, having 60 years of experience. So please, let's try to address our expectations for the fact that we are beginners relatively to him. We don't have the same time, we don't have the same skills, we don't have the same even insider knowledge being a billionaire, right? So let's set our expectation to be conservatively on the 8% return per year, very aggressively on the 12-13% return per year. That is very ambitious, and when we talk about compound interest, you'll see how much of a difference it makes if you make just a 12% return rather than a 10%. Cool? Right. Now, a few more key concepts to help you navigate through the rest of the program. Short-term versus long-term, when it comes to the stock market, we have very different scenarios here. Because short-term investing includes any asset you hold for less than 1 year. Here it's written 1 year or less, technically less than 1 year or 1 year, like exactly 1 year. And the thing is that when you invest in the short term, stock movements, so what we said before, how the stock market, the stock price changes over time, is affected by expectations. And this is why returns vary widely in the short term, because expectations vary every day. Trump says something, or you have something happening new in the market, or there's some new earnings. People keep changing their expectations as we do as humans for our future. How many times in a week you feel different towards your life or towards what you expect in the next day? I hope a lot. If you have emotions, should be the case. And so this is why we want to be long-term investors. Because long-term investing includes assets you hold for more than 1 year, which should be the target here. On average, minimum, I usually invest in something and I keep it for minimum 6 months. That's the bare minimum. I never invest in something hoping to sell it the next month because it's just meaningless. Nothing happens so big in a month that changes the truth of the businesses. But in the long term, stock movements are based on business results because returns award strong businesses. I always make the example of Blockbuster. Maybe when Blockbuster was having some troubles, they still had some green days. They still made some money in a 1-day period. But if we look now, where Blockbuster doesn't exist. It doesn't matter what happened in the short term. In the long term, the business went bankrupt, and right now the stock is worth 0. And this brings us to the other part of risk, which is, the other part of return, which is risk. Risk is what we need to bear. Is defined as the measure of the level of uncertainty of achieving the returns as per the expectations of the investor. In simple terms, it means is the uncertainty of actually making the return that you expect. Like you invest in something, and if you're a good investor, you already have some expectations on what money you will make. You don't just invest in something because a friend said so, but you say, I'm investing in this for these reasons, and I expect to make a 15% return. But that is the expected return. It is the potential return. The real return depends on the risk of not knowing what could happen in the future. And so, a very good exercise to do anytime you want to make an investment is to ask yourself, what could go wrong? And some questions that I ask myself, and I suggest you to do the same. The basic ones are, is the company solid? How much debt does it have? What is the probability it could go bankrupt in the near future? What is the status of the industry? Does it have a future? If right now you were to buy a company that maybe has great margins, but it's in the newspaper business, I mean, that's the direction. Those businesses will die over time. They will move to the online. Talking about the newspaper, like physical ones. So this is why it's always very, very important to say, oh yeah, oh my God, I can make a 50% return on this. Yeah, but what's the risk? What is the likelihood that that happens? How many outcomes there are that this goes wrong? Like, because if you're like, if everything goes well, I can make a 100% return in this investment, but you are considering like one possibility out of 4 millions that could go wrong, like not even Avengers Endgame had these probabilities, well, you know, it's not a very good investment. So this is what risk, what is risk about. And so the relationship between these two is that riskier products need to offer higher returns. Because in other words, you want a higher return to bear more risk. And the additional expected compensation you receive to carry out a bigger risk is called risk premium. Premium over what? Over the risk-free. If you recall here, we said that we never want to accept anything that is below the risk-free interest. That is the return that you should always be able to make, because you can just go to the central bank and get the return from them by buying a bond. We will see how. Anything on top of the risk-free interest, it's called the risk premium part. And so, if right now the central bank, let's make it simple, offers me a 1% risk-free interest, and I'm looking at an investment that gives me 7%, what is my risk premium? 7 minus 1, 6%. That's the premium that I'm paying over the risk-free to bear some additional risk, to bear the fact that this 7% return will never as guaranteed as this 1%. And so, the stronger the entity that ensures the safety of the investment, the less risk premium is offered. They don't need to. The US state controls the stock market so far. It's very solid. And therefore, they can offer a very low return on national bonds because they know they can tell to the investors, hey, we are the US. If we go default, the whole world goes default. And so default is another term for bankruptcy. And so when something is guaranteed by the US state because of their reputation and their history of being very solid, they can say, look, you want to invest with us? We just offer you this tiny thing because we don't need to convince you. You know we are solid. If instead we are a startup, well, how many things can go wrong with a startup? Thousands, right? And so if you're an investor in front of you and you say, hey, US government is giving me 2% and there's like a 0.0001% likelihood chance that it will go wrong, you're a startup. There is a 99% of chance that this will go wrong because 90% of businesses don't go over the 5 years mark. So I want 20%, 30% expected return because I'm bearing more risk. Cool? And so this is a simple chart to give you a bit of a reference on what you should be able to expect. Don't take it as precise as possible because these things change over time, but it's to give you the concept. If we start from the bottom, we have cash. How risky is cash? 0%. The only reason in which cash fails is, again, if the state goes bankrupt. But again, it's very catastrophic consequences. Doesn't happen very often. Then, if I buy bonds, I can get a bit more money than cash. but I bear a little bit of risk because the bond's price can go up and down. They will never fail, but I could have the risk of selling it at a lower price than when I bought it. Well, while cash, $1 today is $1 tomorrow in nominal values. Then we have REITs, real estate mostly, global stock market, technology stocks, derivatives, private equity, up to crypto. Crypto, you buy crypto expecting to make a lot of money, but you also know that it could go just wrong completely in one day. And that's the game. The overall idea is that you always want to move towards this line. Would you make an investment that is in this area? I don't know if you see my what is called mouse. Probably not, because you would say, why would I take so much risk to make the same return of bonds that is much safer? Would you buy an investment that is here, like it's a 25% return with guaranteed 0% risk? There's two answers here. One is yes, immediately. The second one is it's too good to be true, stay away from that, it's probably a scam. If anyone offers you a guaranteed 25% return, no risk, no way this goes wrong, it's a scam, I can promise you. Otherwise, the third option is that you really found the only thing in the world that still offers this return very risk-free. But here's the thing, the moment that everybody knows about this, the return will go down. And so at the end of the day, in the long term, this will always move towards the same line. Anyone that is in this part is a fool. Anyone that is in this part is someone that is just a pioneer, someone that found something that no one else found. Anyone that bought AI stocks in 2021 probably was here, but they couldn't know. And finally, the last concepts that we want to bring on board is the Sharpe ratio. Now, don't get scared about this, because I know that this is a concept that people tend to feel a bit, okay, didn't understand this properly. It's a very simple metric. I'm going to explain you in a second. The Sharpe ratio compares the return you get for the risk you have to bear. It's the simple division between return and risk. So it's a number that tells us how good is the investment compared to something else. So the Sharpe ratio by itself, if I tell you this investment has a 0.5 Sharpe ratio, doesn't mean anything, because you need to ask me in which period of time and what were the other investments doing in that same period. If instead I tells you investment A in 2020 had a Sharpe ratio of 1, and investment B had the same exact return but had a Sharpe ratio of 0.1, what does it mean? It means that the two investments, yes, they had the same return, but because the Sharpe ratio of 1 is much higher, it means that the risk was much lower. Because let's make it simple. Let's make that both investments had a 10% return, okay? But one had a risk, let's simplify, of 5, and the other had a risk of 20, because it went up and down a lot. Risk simply means that the stock moves like this instead of doing like this. So you have investment A that does something like this, risk very low, it still gets to 10% return. And then you have investment B that does something like this, and then at the end it still arrives at 10%. The second one will have a lower Sharpe ratio because the risk will be higher, okay? Which one would you prefer? Well, if you were a robot without emotions, you would say these two investments are the same. But if you had to invest 100,000 pounds and you see your investment going up and down like this, it would be very, you would feel anxious about it. And so you would prefer the first investment with a higher Sharpe ratio. So long story short, if you need to look at two similar investments, find the Sharpe ratio, take the one that has the higher Sharpe ratio. And so we are again at our definition cheat sheet. Let's remember, return, money earned as a reward for taking the risk of an investment. Short-term investments investments that are held for less than 1 year. Long-term, more than 1 year. Risk, measure of the level of uncertainty of achieving the returns as per the expectations of the investor. In other terms, the possibility that things won't go as expected. Sharpe ratio compares the return you get for the risk you have to bear. I hope this was interesting. I'll see you next time. Be stoic.